Hello, welcome back to Retirement Clarity Radio. My name is Scott Newhouse. I am your host. I'm so glad you are with me. Today's episode, we are going to be wrapping up our series on taxes. We've done 4 episodes on taxes, mostly based off my book, The Retirement Tax Bomb: How to Protect Your 401k from Impending Tax Increases and Create a Tax-Free Retirement. You can get a copy of this book for free at freeretirementbooks.com. Again, that's freeretirementbooks.com. Last week's episode was the 6 steps to a tax-free retirement. Today, we're going to be talking about a case study named after two of my favorite TV show characters, Ricky and Lucy, and we are going to talk about the steps that they could have taken to create a tax-free retirement. So, if you want to get more details, if you want to go through the whole book instead of just listening to me go through it, go to freeretirementbooks.com, give me some small contact information, and then you can get this book for free. You can also pay $5 on Amazon for it and get it on your Kindle or get it delivered to your home. Okay, so let's get into today's episode, putting it all together. Now, and I do need to do a couple disclaimers actually. One, I'm going to show you how Ricky and Lucy can do a tax-free retirement. For you, that may not be possible. I just kind of put that out there at the front, but you can still lower your taxes in retirement. So even if you can't get to a 0% tax bracket, you can still take steps to lower your taxes in retirement. My second disclaimer is I would not do this without a financial professional by your side, guiding you, making sure that you don't make any kind of unintended consequences of any of these decisions. They're big decisions. Sometimes you can't take them back. So we just want to make sure we're doing everything properly with guidance from a professional, from an expert, a certified financial planner, a CPA, etc. So those are the disclaimers. Let's get into it. Put it all together for Ricky and Lucy. I said this in the book, but here is the situation that Ricky and Lucy look like at age 55, 10 years before they'd like to retire. So they want to retire around age 65. They have a house worth around $500,000, no mortgage on it. Ricky's 401k has $300,000 in it. His IRA has $200,000, and they have $100,000 saved in mutual funds in a non-retirement account. Next, they have no debt, so that's great going for them as well. Their projected Social Security benefits at age 65 is slated to be $36,000 per year. They want to have a retirement income of $72,000, and then their net worth, adding all this together, is $1.1 million. So, Ricky and Lucy have done really well for themselves. There's no doubt about that. However, they are highly susceptible to higher and unnecessary taxes in the future, which would greatly diminish the retirement that they hope to enjoy. Because, as you know, you could tell from what I just listed out, they've got $500,000 in tax-deferred / traditional type investments, which means they do have to pay taxes on that in the future. And as I talked about in the previous episodes, I do think, not a guarantee, but I do think taxes will rise, and they're really susceptible to that. So here's some smart tax strategies that Ricky and Lucy could have taken to avoid these impending tax increases. The first one, I love this one, they could have both maxed out a Roth IRA. So since they're over 50, they can each put in $7,000 into a Roth IRA. $6,000 is the contribution limit, plus if you're over age 50, you get a $1,000 catch-up. So that would result in $14,000 going into tax-free money annually. Now, you do have to pay taxes in the current year, but when you put it in, you invest it, and then you take it out under the qualified circumstances, you take that Roth IRA money out tax-free. The second thing they could have done is lower their traditional 401k contributions and instead put some or all of that money in a Roth 401k. One thing they'd have to be aware of, though, is that since they're making Roth conversions, Roth contributions, they'd no longer be able to deduct those 401k contributions from their current income, which means they'd have to pay more in taxes this year, but in order to get more of that tax-free money in the future. They would also have to make sure that they don't jump into too high of a marginal tax bracket, i.e., what's their highest tax bracket rate. They just want to be cognizant that they don't bump themselves into too high of a tax bracket. Third, they could convert some of their money in Ricky's traditional IRA into a Roth IRA. The key here, though, is that they would not would not do this all at once. Instead, they would do it gradually over time. Now, since Ricky and Lucy have read this book and they have consulted with a financial professional, they are also aware that they need to have some cash set aside to pay taxes on the conversion amount, because they know that a Roth conversion isn't about avoiding taxes, which is not legal. We're not going to try that. Instead, a Roth conversion is about locking in lower tax rates today so you don't have to pay higher tax rates in the future. So they use some of the money that they have in mutual funds, in the non-retirement accounts, to pay those taxes. They are also very mindful of how much they convert on an annual basis, as they don't want to push themselves into a much higher marginal tax bracket. Now, it might be okay for them to push themselves into a higher tax bracket, but they don't want to go too high. For instance, they could be at the 22% tax bracket and say, hey, you know what? It's okay with us if we pay 24%. If we bump ourselves up into the 24% tax bracket, that's okay with us. But they don't want to go from 24 to 32. So maybe they look at it and say, hey, 22, bumping ourselves up to 24, that's okay with us. But then they say, we don't want to bump from 24 into that 32% tax bracket. Fourth, because they have a solid emergency fund, which is essential for everyone, working and in retirement, and they are lucky enough to enjoy some good health, they sign up for a high deductible health insurance plan, which is not for everyone, and they do one of those plans that has an HSA, a health savings account, associated with it. And they wisely contribute the maximum amount and get the triple tax benefits that come with the HSAs. As I've said before on these podcast series, HSAs, you can defer your income in the current year or lower your income in the current year. Your money grows tax deferred, and then when you take it out for qualified medical expenses, you can actually take it out, distribute it tax free. So that's where the triple tax benefits comes with HSAs. So putting it all together for Ricky and Lucy, after taking these steps for 10 years before their retirement, let's take a look at them now at age 65 and see how their retirement comes together. See how their retirement income comes together. From their traditional 401k, they're able to take out $14,000 a year in annual distributions. They're going to get $36,000 a year in yearly Social Security benefits. They're going to, from their Roth IRA and Roth 401k, they're going to take out $16,000 annual distributions. And in their HSA, they're going to take out $6,000 in annual distributions, which can be used to pay for Medicare as well as other qualified medical expenses, which means they get their total annual income of $72,000. And this is a little hard because I have it in a chart in this book, but I have a chart in here that shows how Ricky and Lucy have utilized all three tax buckets. Our taxable bucket, which you have to pay taxes every year. Your tax deferred, which you lower your income in the current year, but you have to pay taxes in the future. And then your tax-free bucket, which depending on how you get it in there, you're going to have to pay taxes in the current year, and then not going to have to pay taxes again once it gets into that bucket, and you take it out for the qualified purposes. So the strategy they follow is they don't have all of their money in one bucket. Instead, they spread it out among the three, which gives them more flexibility to take money out from whatever is the best way for them to distribute that money. So if you have all of your money in one bucket, you just have less options, and that it potentially increases your likelihood of needing to pay taxes on that money. But if you have your money spread among all three buckets, it gives you a lot more flexibility and options. That is something us finance nerds call tax diversification. Just like your investments need to be diversified, your taxes and where you can withdraw money from needs to be diversified as well. So, doing everything I just mentioned here, Ricky and Lucy's retirement is now tax-free. How in the world is this possible? Let's go through their tax-free income one by one. Social Security. Their provisional income, which I've discussed in a previous episode, is low enough that their Social Security benefits are not taxed. How? Because they used Roth and HSA accounts to generate income, and neither of those accounts is counted as provisional income. So since they are below the provisional income threshold, none of their Social Security benefits are going to be taxed. As a result, this saves them thousands of dollars per year on taxes, and over their lifetime it's going to save them over $100,000. Tax deferred. Ricky and Lucy only withdraw $14,000 from their tax-deferred accounts on an annual basis, which is much lower than their standard deduction, which is $27,000 for a married couple over 65 as of 2016. Those numbers are adjusted for inflation. Therefore, these withdrawals are not taxed because their tax-deferred amounts is lower than their standard deduction. That's a really important point. Make sure that your standard deduction equals or is less than, make sure the distributions you take from your tax-deferred accounts are less than or equal to your standard deduction amount. Next, we have tax-free distributions. As the name states, this money is tax-free. Ricky and Lucy can take money from this bucket coming from a Roth account as well as HSA accounts to meet their living expenses along with their Social Security benefits along with their tax-deferred distributions. And they don't have to worry about paying taxes on this because it's tax-free money, of course. Further, these distributions do not count towards provisional income, which means they don't have to worry about their Social Security benefits becoming taxable because of distributions from these accounts, because it just doesn't factor into the equation. So, to reiterate, here is what Ricky and Lucy have accomplished. They have no taxes from their tax-free accounts. They have no taxes from their Social Security benefits. They have no taxes from their tax-deferred accounts and the distributions there. And Ricky and Lucy are in the 0% tax bracket. That sounds great, doesn't it? So here are the key takeaways I have from this chapter of the book, as well as key takeaways from our tax series. We're going to talk more about taxes, specifically Roth conversions, probably later in this year when we get into the Roth conversion season, but just not right now. So, key takeaways from today's episode of Retirement Clarity Radio. You have to make sure that you use each tax bucket, with the right amounts correctly. Next, for the taxable bucket, you should have around, and these are rules of thumb that I'm going to give out to you. It might differ depending on your circumstances, but for the taxable bucket, try to aim to around 6 to 12 months of expenses in there. For the tax-deferred bucket, try to match your distributions from the tax-deferred with the standard deduction that you're going to have so that there's no taxable income on that amount. Once you get the right amounts in taxable and tax-deferred, any extra money should be redeployed into tax-free accounts, however you can get it in there. Now, do not do this all at once. Try to make changes over the course of many years. However, be careful about bumping into new, higher marginal tax brackets. This next point is so important. Try and act now while tax rates are at historic lows. Taxes are set by law to go up on January 1 of 2026, and there's good reason to believe they're going to go higher after that. So don't leave your accounts as they are while these impending tax increases come up at us. Try and take action today before we get to 2026. And then, as always, consult with a financial professional, certified financial planner, a CPA, before implementing these strategies. So that's all I've got for today's episode. I really appreciate you listening in. I hope this has been of some value to you. If you can take action on a couple of these strategies, I think it'll be well worth the investment that you paid in your time in listening to these episodes, picking up the book at freeretirementbooks.com. So I appreciate you being with us. Our next series of episodes is going to be on retirement lifestyle. What do we want our retirement lifestyle to look like? Where do we want to live? How can we best live? What do we need to be prepared for? All that sort of stuff. That's going to be our next 4 to 5 episodes. So make sure to like, subscribe to this podcast, and I'll see you next time. Bye. Thanks again for listening. As a reminder, you should consult with a financial advisor familiar with the specific circumstances of your unique financial situation before making any financial decisions. Nothing in this podcast is a solicitation for the sale or purchase of any securities. Any mentions of rate of return are hypothetical in nature and not a guarantee of future returns. Scott Newhouse, CFP, is an investment advisor representative of Forthright Finances, a California and Nevada registered investment advisor.